Right, thanks very much. Evening, everybody. Right, let's get going. And let's start with a quick recap of what we looked at previously, which was firstly defining your product, where we had a methodology that we utilized to build up our thinking, and then picking an item out of that methodology. In other words, narrowing down what we were thinking, and then creating a sentence about what our product is. And once we'd created the sentence on what our product is, we turned it into an advert of some sort. We then moved on to who we sell to, and using that advert, we had a sequence of events we went through to turn prospects into customers. Then we looked at infrastructure in terms of basically what are the critical systems we need to look at, leading people help us build the processes, and then clone proven systems that experts had already developed. And then we looked at who can help by creating a team. And there were 9 items we went through in terms of how you create a team. And what we're doing tonight is we're actually going to have a look at how to control your business. And the most important thing to control in your business is cash flow. Because when you talk about cash flow, cash is the lifeblood of your business. And essentially without cash, you can't do much at all. So what do we worry about? We worry about, firstly, when we trade, we need money. We also need a safety belt for when trading doesn't work so lekker. And we also need a productive infrastructure that allows us to build and store stuff we trade. So trade means we move money in and out of our current account. Our safety belt is a savings account where we have 3 times our money out per month hidden away. And productive infrastructure is how we grow. Now, that all fits into a report that we need to control. And essentially, there are lots and lots and lots and lots and lots of things happening in what appears to be a fairly simple report. But I just want to pause here for a second. Because even though there's a hang of a lot going on here, what is important is the following stuff. When I look at people who do cash flow reports, the only thing they tend to look at is their current account. In other words, how much money is coming in, how much money is going out, and basically sales and purchases. To me, that's nowhere near enough. When you run out of money on your current account, where you're going to get money from to just back you up for a short period of time? And the answer is in your savings or in your call account or investment accounts. And then once you've got extra money lying around, what are you going to do with it? And the answer to me is you've got to grow your business. And the way businesses grow is you use the spare money to buy things, infrastructure, that allows you to become either more efficient, more productive, allows you to produce more, allows you to store more, allows you to deliver more. Whatever the nature of your business is, you need to do that sort of thing. Now, there's the basic introduction, which leads us up to probably the most important thing, which is, hey, what does this report look like? And what you've got on the screen at the moment is, that's it. That's the whole report. Except there's an awful lot of formulas and stuff going on here. So for example, the dates at the top, these are not accidental, these are very deliberate. We've got 5 days. So today is the 15th of August. So 15, 16, 17, 18, 19th of August. So there are 5 days there. Then the weeks, we've got 3 of those, which is next week, the week after that, and the week after that. And then that takes us a month from today. And then we have months, and we've got 3 months there, October, November, December, and then just a column for catch-all for anything that happens after December. Now, this date moves. Every time we go into this thing, the first date on the left here, that date will be today's date. So this report, it's incredibly important that you look at this on a daily basis, every single day. And what you do is you manage stuff here. So you obviously put in today's balance. Now, just for the hang of it, let's go and change today's balance to, I don't know, 1,726 Rand or whatever. Boom. The second we hit that, you'll notice a whole lot of stuff changed. And then we put in inflows. In other words, what are our cash sales anticipated for today? Our debtor receipts, other inflows, which might be sale of assets from investments or whatever. Outflows, your cash purchases, your creditor payments, and other outflows, and then stuff you move to investments. Now, the sale of assets will go in down here in the assets section. The outflows to investments will go into this investment section. You can see the stuff happening here. And there's a timing difference, fairly obviously. We move it at the end of the day and we account for it at the beginning of the following day to look at what's happened here. We've also set some limits here. So on our current account, we've said, hey, we'd like our current account balance to be about, and please, these are just examples, about 5,000 Rand. And you'll see it doesn't reach there. It goes over it here. The second it goes over it, look at what happens to the 876 Rand. It automatically goes down to your investment account. In other words, it moves into your safety belt. Also on this day, we actually got 4,000 Rand in, which is why we went up such a lot, from the sale of assets, which happened yesterday, basically, or we recorded under assets. We then move up, there's an extra 50 Rand there, which goes down there, and then we're under the 5,000 again. And then we're short of 400 Rand on this 5th of September. So where do we get it from? We pull it out of the investment account here. That 400 Rand comes out of there and it goes in there. In other words, we're always keeping ourselves positive on the current account to a maximum limit of 5,000 Rand. And you'll see again, when we go over the 5,000, there we went 5,300, the 300 goes into investments. And it gets recorded the following day to investments, etc. Now, what happens here is that when we do, and also, sorry, on the investment account, we have a limit or clearing amount of 21,000. Now, when we go over that, there's one there. We have a difference here of 1,026 Rand, which we can then move to, hey, we've got enough money here to purchase assets. So let's put it there and let's start looking for what we have on our list of what we want to purchase. I'm not going to carry on with this. It's fairly obvious. There's a lot of mathematics. There's an awful lot of formulas here. But what's happening is the following. Yes, we're controlling our current account, but when it reaches a certain limit, we're moving money into our safety belt, our investment account. Now, our investment account's job is to make sure that it is about 3 times bigger than our outflows on a monthly basis, actually. So that what we've then got is, if we have a bad month, we're covered for 3 months. And it means that we can actually sort of weather some bad periods while we get our planning, while we move ourselves up to catch up to what's happened in reality. And then when we do well and we have spare money, we can put it aside to actually grow our productive infrastructure down here. Now, that is a very brief look at what I wanted to show you people. And let's just pull up this slide again, which looks, sorry, I just need to go back a couple of slides. So what we've got is we've got 3 sections we worry about in terms of cash. Our trading section, which is our current account, fairly obviously money goes in and out of that based on our operational requirements. Our safety belt, where we put spare money, and it should be 3 times of the money out per month, which gives us a 3-month leeway to change our thinking and our plans if we need to, if we have bad trade. And then if we've got spare money, we put it into our productive infrastructure, which allows us to do, which makes our business capable of doing more, either producing more, delivering more, creating more, whatever. And that's, to me, what a complete cash flow report looks like. Now, no matter how hard you look at any business, this report needs to be looked at every day. If this report is right, just about everything else in your business will be right. The thing that you watch in business. Now, please, I did not say profit. I did not say any of those sort of things. But having said that, if you're trading and your money out is greater than your money in, then fairly obviously you're eating away at your safety belt and you're not capable of growing by buying more productive assets. So making a profit is essential. But what this sort of reporting allows you to do is to make sure that you're actually not going to hit the cardinal sin in any business, which is running out of money. Not just that, you know, it is unlikely, or let me try and put this in a nicer way. If you decide to buy a whole lot of stuff in anticipation of future sales, and you actually buy the stuff, thereby using up your cash, I think you've made a huge mistake. You need to make sure that you are ready to buy a lot of stuff once the demand catches you. So it's a fine balance between buying stuff. Well, let's put it another way. The timing of when you buy stuff matters. So don't buy stuff until you know you're going to need it, which you've got to watch really, really carefully. Because I've watched the worst thing that can happen to a new entrepreneur is they've got money. And they've got lots of money. Because entrepreneurs love to do things like, let me fill my shelves with stock, let me, etc., etc., etc. And you will find that at the beginning of a business, before the entrepreneur actually knows and understands his customer base, they'll buy the wrong stuff. So to me, you need to be ready to buy, but you only buy when you know you're going to need it. So it's not that straightforward. And in answer to your question, you should not buy that much that you've got to wait that long before you can turn it into cash again. Well, again, there's no difference between selling services and selling formal products, because you're still selling. So if we look at the spreadsheet here, your inflows would be obviously the same thing, debtors, receipts, etc., and other inflows, and the sale of assets if necessary. But your outflows would be things like your petrol, your, you know, whatever, the equipment you needed to buy in order to demonstrate or present or whatever. Now, fairly obviously, your pattern of outflow and inflow is different. But understand something, product is product, whether it be a service or a physical, tangible thing. It makes no difference. And understand as well that you know what your inflows and your outflows are and what the timing of them is. And that's what's important here, is the timing of everything. Because the only time you run out of cash is when you don't anticipate that something's going to happen. So I hear your question, but I don't understand why you think it's so different. If you want to, you can get very specific and put the debtor's name in, for example, or the project name or whatever.
Okay.
Remember, this is your spreadsheet.
Sure.
And what I've done here is I've just done an example that illustrates a principle. This is going to be your daily working document, and you need to make it work for you. So whatever detail you wish to go into, you must put it in.
Okay.
However, be very careful that you're not repeating your accounting system. In other words, your accounting system knows which debtors paid you. This is a summary of how much money came in. You know,
is it a better position to do it by project?
The answer to that question is yes and no.
Mm.
Well, let me tell you why I've given you both answers. Remember, your
Yes.
cash flow is about your total business.
Okay. Yeah.
However, very, very often, it is a good idea to watch the cash flow on a single project.
Yes.
So what I tend to do is, if the project is big enough, it'll have its own cash flow report.
Yes.
Otherwise,
What is
it
big
just gets
enough?
big enough is if it's putting in more than sort of 20% of your total cash flow.
Okay.
Otherwise, I lump everything together, because you can also get into an admin loop where you're so busy doing admin, you're actually not doing any work.
Yeah. Yeah.
Um,
And you
so
won't be
need to
able to lose the specific weight of the project in the rest of the figures if you lump it together.
Most entrepreneurs usually work on one, maybe two projects at a time.
Mm.
So the answer is generally no. However, the larger your company gets,
Yes.
then what happens is the person in charge of the project has a project cash flow, and that is summarized up into a company cash flow.
Okay, great stuff.
You know, if the company is large enough to warrant that sort of thing. Just picking up on a comment you made, you're saying that COVID, etc., has sort of changed the way we do business. I disagree. The truth never changes. The way you successfully run a business never changes. What happens, though, is that when things go well, in other words, you're making a lot of sales, and people get lazy. And as a result of that, they say, oh, I don't need to do this. I can get away without doing that, etc. If you stick to the basic rules, and I'll never forget the most important lesson I learned from an old cobbler in the suburb I grew up in Joburg, called Yeovil. This guy had a little black book. And the left-hand side of the book every day was money in, on the right-hand side was money out. He made sure that every day money in was greater than money out, and that's the only control he had over his business. To me, that is the most sensible, grown-up thing to do in a business, even though it's so simple. And I don't believe business gets any more complex than that. But the big problem is people don't keep their eye on the ball because things go well. And I think that what COVID has done for us is to remind us that the basics are still the same, and that our job is to make sure we keep our eye on them. So that, to me, is the most important thing that's happened during COVID.